Imagine receiving a $5,000 check from the government. This is the promise of the Doge Dividend, a plan endorsed by Elon Musk and allegedly supported by President Donald Trump. This proposal, with its potential to shake up both personal finances and the cryptocurrency market, has sparked intense debate. The idea originated with investor James Fishback. He leads the Doge Department of Government Efficiency, a newly formed entity within the government. Fishback proposes cutting $2 trillion in government spending. This ambitious goal, if achieved, would free up funds for the Doge Dividend. The mechanics are simple. 20% of the savings, a hefty $204 billion, would be distributed directly to American taxpayers. Each household would receive up to $5,000. This direct cash injection aims to stimulate the economy and provide relief to struggling families. However, the Doge Dividend has its critics. Some question the feasibility of achieving such massive spending cuts. Others worry about the potential for inflation. Despite the controversy, the proposal has ignited a national conversation about government spending, cryptocurrency, and their intersection. The Doge Dividend immediately draws comparisons to the 2020 to 2021 stimulus checks. These checks, distributed during the COVID-19 pandemic, had a significant impact on the cryptocurrency market. Many Americans, flush with cash, turned to investments. Bitcoin in particular saw a meteoric rise. Consider this. A $1,200 investment in Bitcoin in April 2020 would have been worth over $17,000 by February 2025. This represents a staggering 1,343% increase. The Doge Dividend, with its potential to inject billions into the economy, has sparked speculation about a similar crypto surge. However, the economic landscape of 2025 differs significantly from 2020. The pandemic-induced recession is over. Inflation, though, remains a concern. This uncertainty makes it difficult to predict how people will use their Doge dividends. Will they invest in cryptocurrencies like Bitcoin and Dogecoin, hoping for another boom? Or will they prioritize paying down debts and covering essential expenses? The answer likely lies somewhere in between. The big question surrounding the Doge dividend is how people will use the money. Will they HODL, a crypto term for holding onto the asset long-term, hoping for future gains, or will they spend it on immediate needs? Mati Greenspan, CEO of Quantum Economics, believes that most Americans will opt for the latter. Unlike in 2020, many are grappling with rising living costs. The Doge dividend, for them, represents a much-needed financial cushion. This suggests that the impact on the crypto market might be less dramatic than some anticipate. Furthermore, the crypto landscape has evolved since 2020. Institutional investors now play a more prominent role. Their investment decisions, driven by sophisticated strategies, are less likely to be swayed by a one-time event like the Doge dividend. This is not to say that the Doge dividend won't impact the crypto market at all. Greenspan argues that Dogecoin, the namesake of the initiative, could see renewed interest. He points out that Dogecoin is the only meme coin that has managed to occupy the US government and effect positive change. This association with a government initiative, however unconventional, could boost Dogecoin's visibility and potentially its price. While the immediate impact of the Doge dividend on Bitcoin is debatable, the proposal raises broader questions about the future of cryptocurrency. Could this be the start of a new era? One where crypto plays a more central role in government policy and personal finance? The Doge dividend, despite its unconventional nature, represents a significant intersection of government and the crypto world. It acknowledges the growing presence of cryptocurrencies in the economy. It also highlights the potential for using these digital assets for policy initiatives. However, the proposal's reliance on Dogecoin, a cryptocurrency often perceived as a joke, raises eyebrows. Critics argue that this undermines the seriousness of using crypto in a governmental context. They contend that it risks turning a complex issue into a populist stunt. The Doge dividend's long-term impact on the crypto market remains to be seen. Will it inspire other governments to explore similar initiatives? Will it lead to greater mainstream adoption of cryptocurrencies? Or will it be remembered as a fleeting moment, a curious blip in the history of both cryptocurrency and government policy? The Doge dividend is a bold and controversial proposal. It has the potential to reshape how we think about government spending, cryptocurrency, and their potential intersection. Whether it will live up to its hype remains to be seen. Proponents view it as a game changer, They argue that it could stimulate the economy, provide much-needed relief to taxpayers, and usher in a new era of crypto-integrated governance. Skeptics, however, see it as a publicity stunt, a fleeting moment of populist appeal with little long-term impact. The Doge Dividend's success hinges on several factors. The government must first achieve the proposed $2 trillion in spending cuts, a feat many deem improbable. The public's response to the dividend will also be crucial. Will they invest in cryptocurrencies, bolstering the market, or will they prioritize immediate needs, limiting the impact on crypto? The Doge Dividend is a gamble, a high-stakes experiment with uncertain outcomes. Whether it proves to be a stroke of genius or a costly misfire, one thing is certain: it has ignited a debate that extends far beyond the realms of cryptocurrency and government policy. It has prompted us to reconsider our relationship with money, technology, and the role of government in our lives.